With BIS Commodities, taking a look at the markets this week, or the markets in review. Let's start out and see where we close for the week. Taking a look at the corn market, we did see May corn close down almost 10 cents at $3.77. The December contract closed 8 cents lower at $4.02.5. Soybeans seen a weak as well, down just about 35 cents in the May contract at $9.51.5, while the Noves closed down just under 32 cents at $9.42.5. Little weaker in the week as well. The May contract closed just under 10 cents lower at $5.26.5. Livestock market, April cattle futures closed $4.22 lower at $158.80. We've seen the hogs in the April contract down 67.5 cents at $62.50 on the week, and it looks as if oil may close higher on this week, about $1 or so higher around that 51.73 to maybe 52 area, depending on the close this afternoon. Taking a look at the main market drivers this week, if there was one, or main piece of information, if there was one this week in the grain and soy complex, would be the monthly supply and demand report, where we were going to take into account the carryout, taking into account what the carryout number was going to come out from the release of last week's quarterly stocks report. And just a reminder, we did find more corn in the stocks report last week, as well as a few less soybeans than anticipated. How were we going to work that into the carryout? Well, we did see the carryout increase this week to 1.827 billion bushels of corn. That's up from last month of 1.777 billion bushels of corn. So we did see a 50,000 bushel increase in the carryout. The trade was looking for a larger number in that, some whispered numbers even up to 100,000. We didn't see that all come into play this week on the carryout. Basically, where we seen it come into play was we reduced our feed and residual number 50,000 bushels, and that was the only change to the balance sheet. Taking a look at the soybeans, we were looking for a small decrease in the carryout number there. We came in at 370,000 bushels. The trade was looking for right there at that number, nailed it on the head. Last month we were at 385, so the numbers came in right as expected. What we've seen the USDA do was increase the residual bean number to offset some of that supply. We also did increase imports a little bit as well. So those were the main drivers as far as information this week. But the other thing from this point forward is obviously weather, and how will the managed money handle the weather in upcoming weeks. We did get a commitment to traders report this week that suggests that the managed money held firm in the corn market, and this is a report that's recorded through Tuesday of every week, so we didn't see Tuesdays, Wednesdays, Thursday, and Friday's trade, so it's about a week lag. But the managed money is sitting fairly neutral on corn. They're long around 9,000 contracts this week. Not a lot of activity. I would probably suspect that we've seen that even draw down closer to neutral upon the weakness this week, and a little bit of open interest increasing as well. So I'm looking at a real neutral number, a very neutral number there in the corn market. Soybeans, we did see a little bit of selling in the soy complex from the managed funds. They are holding a 48,000 net short position right now. I would suspect that position probably grew this week with a few more shorts as we've seen the soybeans sell off the tail end of the week here on the report day or prior to the report. The wheat market, we're still seeing a large short there as well, seeing a little increase in there, and the managed funds are holding roughly a 71,000 short position there. So when you take a look at these markets right now, as far as an investment vehicle, the outside money certainly isn't really that interested at the moment, and I think the release of the report at 11 o'clock Thursday, yesterday, was some very good evidence that we didn't hardly see any volatility or movement in the futures upon the release of the report. So at this point, they are holding their shorts, and soybeans and wheat fairly neutral on corn. The question at this point is what drives them back into the market. Could be the other outside markets. Could they pull money out of the market and put them to work in the commodities? Maybe. But with the dollar continuing to push harder, it's harder to be bullish commodities. But at the same token, they are holding a fairly large short position in soybeans and wheat, and if something sparks concerns for them, you could see a quick hard short covering rally. On those rallies with the fundamentals that we know, especially in the soybeans, one would want to take advantage of a short covering rally if it were to come to light, to get some hedges or sales in place. Corn still seems to be range bound. Technically, it's on the bottom end of the range. Mother Nature is going to be the ultimate driver over the next 2 to 3 weeks. It's obviously dry in the northern plains part of the country, and obviously wet in the delta and the southeast part of the country. Next Monday, after the close, we get our first planting progress report for corn. I would suspect we'll be behind the 5-year average, and probably for a couple weeks, but I don't anticipate a very large bullish play on that as the Illinois and Iowa continue to be the driver as far as planting progress is concerned. So with the reports behind us right now, Mother Nature will be the ultimate driver here, and or something to excite investment money to come back into the corn and soybean market. Taking a look at the livestock markets, a very volatile week for cattle futures. We've seen the April contract push to new highs, recent highs this week, only to close lower on the day. A key reversal in that futures contract, bearish on the charts, follow through to the downside Tuesday, only to close higher on the day with everybody scratching their head. We continue to see a range-bound trade until today. We did see us take out Tuesday's low and push lower, and we closed the limit down today in the April contract. Technically a very bearish situation. Cash, very sporadic trade so far today and yesterday, looking at steady at best, unless we see a larger trade yet later on this afternoon. One thing is to keep an eye on is that April chart formation. If we were to gap this thing down on Monday morning, some will be calling for an island reversal in April futures. It's hard to get real bearish here at these levels when you're trading at such a discount to the cash. Cash is still significantly stronger in futures. It's as if though somebody suspects the cash is going to fall out of bed here in the next several weeks coming at us. Hog market, hog futures, a little bit lower on the week as well, but it's the opposite of cattle as far as cash is concerned. Cash continues to trade at a discount to the futures market, and April futures continue to trade at a premium to the hog index as well. I would probably take a look at the June and July futures contracts as an $80 area to maybe make some hedges, put some hedges in place. It looks like it'd be an area of resistance from a futures perspective as well, and certainly $80 or close to it would be quite a premium to what the cash is trading right now. We are expecting pork production to increase in the second, third, and fourth quarter of the year. Interesting of note, though, that the last 2 weeks did see our slaughter weights below last year's level, and the last 2 weeks were the first time this year that we did kill lighter hogs. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525, or check us out on the web at biscommodities.com.